Hey everyone, I'm going to answer some questions that some people have. Again, my name's Andy. My channel's Finding Value. If you like investing or if you like commodities, because we talk a lot about commodities, this is the channel for you, so click subscribe. So question one, recently bonds are getting hammered, yields are rising, and the dollar is rising, well, the short term at least. Would it make sense to hedge a precious metals or PM miner position against one of the above instruments to capture either short-term gains or reduce risk? I'm not doing that. I'm just cost averaging into precious metals and some of the mining companies, whether it be mining precious metals miners or not. So I am not doing that. I don't think the dollar can have a long-term or medium-term or even really a short-term rise. Like it can go up and bounce around a little bit. I don't think it can go up substantially. They can't have it go up. That means interest rates are going to go down, and people are they're going to have to migrate into the dollar. And remember, the dollar is measured against other toilet paper currencies. It's not measured against an ass like something like gold. Gold is money. So what I think is going to happen is that perhaps the market's going to find out that the dollar is going to have to go down substantially. They're going to have a weaker dollar because they have to print more. They're going to have inflation, and they're going to have to hold interest rates down. Why are they holding interest rates down, and what is the cause of interest rates going up? I think it's inflation or the perceived threat of massive inflation coming. Once that inflation comes, I mean, this is going to be game on for precious metals. I mean, game on. We're going to see a rocket launch. And question two, if now is not the time to enter into any of the bonds or dollar type instruments, should we have them on our radar for future interest since they are taking such a beating? Or do you think there's still a lot more room for the downside for these instruments and they are untouchable for now? What ratio or economic activity would suggest that we would be thinking of starting to accumulate? So good question. I think when real estate peaks, we go into an expansion phase, it peaks, and it's starting to head back down, that's your time you pick up bonds. Because when real estate contracts, it is deflationary, and bonds would be the spot to be. And it's done that for 2008 crash. That's because the real estate market crashed. It takes everything with it. Bonds went up because interest rates go down. People run into bonds. And almost all the crashes on the recessionary side of real estate, you want to be in bonds. And then you want to transfer into stocks. You buy bonds. So let's say we originally are in inflationary period in an expansion phase of real estate. The expansion phase goes up. Housing starts to roll over and come back down because we've built too much. We're coming back down. We go into bonds. When that housing comes back down, we have a recession because it's deflationary when the housing starts go down with the loaning and real estate. So real estate prices go down. They make less loans. They're not making loans against new homes, which is very deflationary. We have to cut back on new home builds. And then, so we're in bonds as that deflation comes. Once it starts to bottom out in a recovery phase of real estate, we want to go into stocks. Stocks do very well with low inflation in a recovery phase of real estate. And this recovery phase in real estate has lasted a pretty long time just now because we're just entering an expansion phase from 2009. It's a long time. It's over 10 years. And that's why stocks have done so well. What's coming up because we're in an expansion phase is the inflation. Precious metals will be a spot to be. And precious metals really started taking off, I'd say, in the past year or two. So at least gold. So it's coming. We're in a pullback right now in precious metals, and eventually you're going to see them rocket. That's my opinion. Something major is going to happen, and we have to watch real estate. If real estate goes and pivots, it doesn't pivot fast. It's not like something you're going to wake up and the next day it's down 10, 20%. It doesn't work like that, at least not in history. If we see the metrics in real estate start to change, we see prices start to roll over and come back down, then I will change my opinion on a dime if I see that. That means we have to sell out of our stocks if we're going to have a real estate crash. If real estate crashes, the thesis is done. It hinges on the pillar of real estate. Everything in this market does. Real estate sets the conditions for investments. Because if we have a rising inflationary period, a rising housing starts in an expansionary phase, which means we get more inflation, that affects interest rates. And we're seeing this all real time happen right now. And I don't hear too many people talk about real estate and the real estate market affecting the investment environment. I just don't hear it on any other channels. And that's why I created this channel. That is my opinion. And then demographics is ultimately what affects all of that. So I'm really looking at real estate, which is looking at demographics, or an underbuilt scenario in real estate. We are underbuilt by 4 million homes. And that's a fact. You can look it up anywhere online. Just type in 3.8 million home deficit or 4 million home deficit, and you'll get some articles that come up. And we have to build all those. So I'm not touching bonds. I don't see, if we would have to see yields be going down for me to want to like bonds. They are doing QE to hold interest rates down. So we'll see if they're successful at it. They might not be successful at holding them down, but we'll see. Thanks for listening. This is Finding Value.